Hey there, traders and investors. Todd Gordon here. It's Wednesday night, August 2nd, and big news last night. I was mountain biking after a pretty good trading day, and then the alert came up. Why not? First debt downgrade in 12, 13 years. So hit the market hard. Let me unpack what's going on, give you the perspective. I'll show you the market that is moving, which I thought originally would be very bad for the stock market, and there's something that's changing. I'd like to show you that, all sorts of things. So let's hit it heavy. Again, before we jump in, one of the key markets that I've been focusing on in the free video here and with our clients, the wealth management and clients of the research business, is interest rates and fixed income. It's really having such a big impact on the stock market. So let's jump in here. So the first thing that you're going to see is we're getting a little economic on you here. Going back to our economics class, I guess it'd be macro, looking at U.S. federal deficit as a percent of GDP overlaid in the S&P. And we saw a debt downgrade back in 2011. The S&P Ratings Agency downgraded us to AA plus, right? And then this was the most recent downgrade by Fitch. And what I kind of found interesting is it was about 2.5, 3 years after the GFC, global financial crisis, where the Fed dumped a bunch of money in the form of quantitative easing. And then they were like 2-3 years later that they downgraded the debt, and market's like, yeah, that's great. And the stock market rallied ever since. And interestingly, S&P hasn't set the rating back. Well, Fitch just did the same thing. You can see the very big spike down. U.S. federal deficit as a percent of GDP got down to like 14%, 15%, and it's rallied very, very sharply back as the market has rallied too. So will it matter? We'll see. One thing that I would say is if you look at the percent chance of a rate hike in September after last night's news, you think that with a credit ratings agency downgrading our debt, maybe the Fed wouldn't be so likely to raise rates to increase the cost to service our national debt. It didn't really move at all. It dropped like 2 percentage points. Still like a 20% chance of a September hike and like a 28% chance of a November hike. So really didn't do that much, okay? Just to give you a little perspective there. So the big thing, one of the markets that, I'm focusing on that, is the 10-year yield. And I kept saying if we go above 4%, it could hurt the stock market, and it could specifically hurt those higher valuation growth stocks. Well, I'm starting to change my mind on that a little bit, and I'll explain why. So this is the 10-year yield. We popped up against 4.09%. We closed at 4.07. Might we get back up to the October 2022 highs up around 4.3? We shall see. Now, previously I would have had a problem and said that probably is going to hurt the stock market because there's a very good correlation between higher rates and lower growth stocks as the market rotates into value, and that was the big relationship we saw in 22. So just kind of doing a macro review here. So again, those are the 10-year yields in green pushing up, and one of the big drivers as yields pop is inflow to the U.S. dollar. Okay, so higher our yields, the more attractive our investments are to international investors, especially as we're paying 5% on short-term paper. What happens is that creates the carry trade. So they'll sell lower yielding currencies with the cost to borrow is very low, like in Japan, and then they'll take that money, buy the dollar to buy our higher yielding products, and that's an arbitrage, and that's the carry trade, and that's kind of what set up the massive volatility spike during global financial crisis. Okay, unfortunately, the bad news is there's a pretty long-standing correlation between stronger dollar and lower stock market, which is up here in teal, or in purple, I should say, right? So, okay, so we're starting to get a strength in U.S. dollar, strength in yields, and the S&P is starting to roll over. Is this something that is going to sink the ship? Okay. Well, this is a excerpt from a report that we sent out to our customers today. So this is if you've been following along this channel, you've seen this before. So this is an overlay of the U.S. 10-year yield, which I just showed you, and the Vanguard value growth ratio, right? So what this means is as this blue chart is going up, value stocks are outperforming growth. And what's the key driver there? It's yields. It's U.S. yields. The higher the yield during the inflationary spike, people would prefer to rotate out of growth stocks into value stocks that are more reasonably valued, pay a dividend, lower beta, lower volatility, et cetera, et cetera. Well, this divergence has started to come apart, right? As yields have gone up, as just mentioned, up around 4%, value has been selling off relative to growth. And I kept saying, man, if we're going to break up through 4%, is this going to reverse? And all of a sudden, the value growth ratio will play catch up to the yields. It's not really happening. It's not really happening. And even with the Fitch downgrade today, which you expect the market to get absolutely just wrecked, didn't really happen that much. But we are seeing a little bit of a rotation into more cyclical stocks, not value stocks, but more cyclical stocks like financials, I would say materials, and I would say industrials. And that's going to be one of the key markets we're going to look at. I'm going to give you two setups that we may put on with our clients tomorrow, but I'll give you a sneak peek on those guys. Okay. All right, so let's take a look. This is one of the things that I find interesting. We're going to get a little heady on the macro stuff here, but it's important as an investor for you to understand this. So this is the 2-year yield. We've been looking at 10s. Let's look at 2. Overlaid with the S&P 500. And this is going back to early 2023, okay? So 2-year treasury yield pushing up, and the 2-year yield spiked up around 5%. Now, this is a very key driver of where the Fed sets their short-term rates, right? Well, as yields have gone up, as the short-term rates have gone up, as the Fed has raised rates, the stock market's actually done fairly well. Everyone kept saying, well, oh man, why buy stocks when I could get, 2-year treasuries at 4.2, 4.3, 4.4? Well, great, except the stock market went up 18% since the March of 23 low, while rates went from 4.25 up to 4.8. And of course, your treasuries that you're holding are losing value, right? Well, what I find interesting here is, and I'll show you in the next chart, 2-year yields just made a lower high. And again, this is going to kind of lean more, swim more into the shallow end of the pool where the Fed is moving short-term rates. So these guys made a lower high as the stock market was making higher highs, doing okay with it. This was the hit with the downgrade last night, right? So short-term yields are diverging from the stock market. I would say that's constructive. And there's something else that's happening with the 10-year, and I'm going to pull it all together. And it's something that I think a big question that a lot of investors have in their mind, and I'll kind of fast forward to it, is yield curve inversion. And I'll pull this whole story together if you can hang with me. Okay, so here's the 2-year yield, as I just showed you, making a lower high. What did I tell you just happened with the... what did I just tell you that happened with the 10-year yield? We broke above 4%. And over the last 2 months, or even more than that, I would say, oh, shoot, that's not good for stocks or the growth trade. Well, what's happening, I think, in something that's changing is the longer end rates are going up, which previously threatened the growth trade. But now you're having a diverging short-term 2-year yield. So what does that do? If you have lower short-term rates and higher long-term rates, it might start to solve the question that a lot of investors have said is why the stock market will sell off significantly: inverted yield curve. Okay, inverted yield curve is quite literally your short-term rates being higher than your long-term rates. So if your 2-year yield just made a lower high, while your 10-year yield just made a higher high, that is normalizing the yield curve a little bit. Okay, so that may be a good thing. So again, I was saying, man, like if we go 4.0 bid in the 10-year, growth's going to get cracked, and that's not really happening. Cyclical stocks are doing okay. Tech's hanging in there. We have Apple and Amazon tomorrow. So I'm actually starting to warm up to this a little bit. Okay, so possibly yield curve normalizing after inverted yield curve. Okay, so one group that I'm going to look at here with you are the industrials, and I would say they're more cyclical. They're not growth, but they've been trading like growth. I'll show you a couple of trades. This is SAIA. So this is a trucking stock within the industrials. I have a little bit left. This was a trade that we put out with our customers at Trading Analysis. We were long from 345, just took profits. It looks like we might get a little bit of a wave for pullback here, which is buyable again. Okay. All right. Now, there's one other thing I want to try to show you, which is right here. Okay. So these are two industries within industrials that are doing well. Okay. So what we're looking at here is a rotation, a relative rotation of industrials. And we're benchmarking against the S&P, and this is a weekly. So XLI is in blue. This is your sector ETF that tracks industrials. And we are rotating in from lagging and moving up here and improving, and it's headed into leading, which means that's outperformance relative to the S&P benchmark. Two sub-industry groups within industrials that are doing very well are building products and passenger airlines. Okay, so I'm going to give you two stocks inside of there that we may be looking to trade tomorrow within building products and passenger airlines. Okay, first one, small cap. This is a $5-6 billion market cap company, small cap industrial. They're manufacturing air conditioning HVAC units, right? You know, it's a big market. It's a big distributor and manufacturer, I should say. But AAON, beautiful wave count here. Looks like we may be heading into a third of a third. And talk about a stock who did not care about Fitch downgrade here. This thing looks like it wants to continue to go. So we might be looking to enter, if we can get any kind of pullback, that'd be great. And the kicker is they have earnings tomorrow. So upside could be into 120. Now another one, much more well-known industrial within passenger air. And again, that was, you know, that guy was part of the building products sub-industry group I just showed you here on RRG. The next one's going to be in passenger airlines. Can you guess which one it is? It is one that has worked off the most debt from the balance sheet from the pandemic. One of the stronger airlines out there. You probably know it. So let me do the big reveal here. It is Delta. Loving this little wave for a pullback in Delta. I've been watching this. SkyWest had a good move. United and American aren't doing too much. JetBlue did not report solid earnings. Delta already came out, and I'm liking the pullback here into Delta. Stops wouldn't have to be too much below 41 bucks, and if it is a good wave for, we should be able to move close up into the 50s here. And you're looking at a big old solid triangle break after huge consolidation. So we're trying to break above there and possibly get up to the March 09 of 2021 highs. Okay, guys, hope that helps. Thanks for hanging with me. Let me know what you think about that. Is the yield curve normalizing, and can long-term rates not sink the stock market? Maybe it's a good thing. Let me know what you think. See you guys later. Hi, it's Todd from tradinganalysis.com. Thanks so much for watching. Listen, my team and I have so much to share with you in terms of our technical analysis, our fundamental analysis, portfolio management tactics, trading in and out, maybe options, sector rotation. Let us know what's most interesting to you. Maybe drop that in the comments section and we'll do our best to work it in. Also, consider clicking the subscribe button and the bell icon to be notified when we put out new videos. And finally, you can check us out at tradinganalysis.com if you'd like to see us manage our real portfolios in real time. Thanks again for watching.